We were talking last about depreciation, and we talked about it, how it affected the balance sheet and the income statement, and using these separate account, and a new account which we introduced was a contra account, and also talked about how the depreciation methods would differ between companies. We have something quite similar to that in this PowerPoint that I want to discuss, and that is amortization. It's very similar to depreciation. We will be using up an asset over time. We will be creating a contra account. The only thing different is instead of calling it depreciation, we will be calling this amortization. Now, let us say SonicGate here purchased software. It's reasonable to assume that this software is not going to last forever, and therefore at the end of a time period the software should probably have a zero balance in that account. So it's an asset account, should have a zero balance at the end of a time period. In this case, they think it will last 3 years. Well, what is going to happen is, like depreciation, we are going to take the value of this software, we're going to allocate it to the time periods, and we are going to determine how much we should have for each time period. And the time period is a month. In this case, the estimate is $250. So instead of having accumulated depreciation, we'll have accumulated amortization. And instead of having depreciation expense, we will have amortization expense. So in recording it, expenses again should be recorded as debits, and the credit is not going to be the software, but the credit will be done to an accumulated amortization account, reducing the balance in that account by $250. So we initially purchased the software for $9,000, and we have, like depreciation, we are going to use it up, and we are going to create an account that accumulates the using up of the software. In this case, we have used up an accumulated amount of $250 at the end of this first month. Every month we would do the same thing. Just like in depreciation, we would record an amount going to an expense and going to the contra account to reduce the balance in the asset account, and so that the financial statement, the income statement, shows the proper amount being recorded. Gift cards are very interesting. I know most of you have probably received gift cards. I have received gift cards, and sometimes I lose those things. But gift cards, if you were the company selling the gift card, you wouldn't be able to record the revenue from just selling that gift card, because you really wouldn't have done the thing that your company does. And in this case, with SonicGate, what they do is they provide game downloads. So game downloads is their normal business. That's how they get their revenues. So just selling a gift card, they don't get to record the revenue. At that point, we call it unearned revenue. Now, in the future, as the gift cards are used up, then they get to record revenue. So what we are going to do in this case is we are going to remove the liability, and then we are going to record the revenue. Okay? So this is showing up here as a plus. It should be a minus. You might want to make note of that. I don't have an easy way to make that change or that modification in the PowerPoint itself. I'm just going to note that they have it wrong up here. It's proper down here. We have a liability which has a normal credit balance. We are debiting it to remove it, and we are also recording revenue. If they had, instead of using up the gift cards, if the customers had come in and they had paid for these downloads with cash, what would the revenue have been? Well, when we would have recorded that transaction, we would have debited cash and we would have credited sales revenue. So it really doesn't matter as far as the income statement goes whether the customers bought the game loads with cash or whether they bought them by redeeming their gift cards. Either way, our revenue is the same. And so this is again that general principle that revenue should be based on what the company does versus the way it is paid for, or versus the cash flow. Alright, doing this then, another interesting thing comes out of it. I just discussed this and the fact that sales revenue would be the same whether it was a cash transaction, accounts receivable transaction, a gift card redemption, still would have been the same sales revenue. But the other thing that's interesting is we began this time period with $300 in gift cards. That is, the gift cards owed, or services owed to customers who had purchased gift cards on behalf of other people. After these customers came in and redeemed the $100, we now owe $200 in gift cards. So we could expect up to $200 in gift cards being redeemed in the next time periods. That's just what we can expect based on selling $300, $100 being redeemed. That leaves us $200. So when we look at this again, we can see that if we do adjusting journal entries properly, we can look at each individual balance and ask ourselves, does it make sense? And it will make sense. We can also provide services. By performing services, we can earn revenues and not get the cash in yet. So it's the opposite of deferral. In this case, we are going to record an accrual. This is something probably you've seen before. It's an account receivable. In other words, we are doing the work now, but in the future, we are going to receive the cash. So how we record this is we record this asset called a receivable, and we record the service revenue. Now, just like in the other transaction, it doesn't matter whether we receive this revenue through cash, through accounts receivable. When we go in and we look at our service revenue account for this time period, we see $2,500, and that's the way it should be. It shouldn't depend upon how we are going to be paid, the amount that we record in revenue or in the income statement. Now, the other thing to note here is that going into it, our customers owed us $500. Now another $2,500 is going to be owed, so our total combined amount which is owed to us from our customers is $3,000. When our employees work, we also need to pay them, and we need to record the expenses associated with their work. We need to accrue those expenses whether we pay them or not. So we need to show it in our income statement. And since it's not paid, we call it a payable, and it will be recorded another debit expense and creating a liability for $1,200. Now, we have probably paid the employees with cash up here for the $7,800, and the $1,200 represents the amount we have not yet paid them, but the total amount of salary and wages which is incurred related to our revenue process for this month would be $9,000. $1,200 again owed to customers, owed to our employees. Interest expense goes along with our notes payable. It's not really relevant whether we pay it or whether we don't pay it when we're looking at the income statement. We want to know, how does this interest expense match up to the time periods, or how can we get the interest expense in the right time periods? And so you're going to apportion it or put it into proper time periods. In this example, Sonic Gate has not paid or recorded $100 in interest that it would technically owe for the month. So again, you're going to debit expense, create the payable, record the payable in there. Income taxes. Every time you have an income statement, you should show income taxes. Just like when we pay our income taxes, we pay our income taxes at a later date, but we technically will owe for those income taxes after the end of that time period. Here, Sonic Gate pays income taxes based on 20% of the company's income. If we go to the financial statement as it stands now, after our adjustments have been put in there, we can see that they have a net income of $1,000. The tax rate is 20%, meaning they will have to pay $200 in income taxes based on this net income. Again, income tax expense, income tax payable, and when we go in here, we're going to see that our income tax payable or our liability account owed to the IRS is recorded for $200. And this $200 relates back to our before taxes income statement. There are a few additional things that we should think about here. When we do adjusting journal entries, it never involves cash. And also, there's always one balance sheet item and one income statement item in every journal entry. After we have posted these, what we call the trial balance is an adjusted trial balance. This is an interesting thing here because in the previous slide we had unadjusted trial balance. Now we have just adjusted trial balance for the month of September. We go through and we look at these accounts. I believe we didn't have any salary or wages payable. Now we show it. We didn't have income tax payable. Now we have it. Accumulated depreciation is now showing up. Accumulated amortization is showing up. We go through depreciation expenses now here. Our supplies has been adjusted. Amortization expenses here. And interest expenses here. Income tax expenses here. So after adjustments, we have some account balances that have changed. And the adjusted trial balance reflects those new updated totals in the account balances. After we have the adjusted trial balance done, we can go ahead and work on our financial statements because we've put in all the work we need to put in there in our financial statement accounts, in our accounts, our ledger accounts, up to the time when we do our financial statements. So now we can proceed with those financial statements. Important here, the first one you do is the income statement. So you go down to the accounts which show up on the income statement. Really easy to pick these out because they're at the very bottom of the listing, because this is all done according to the chart account numbering system we talked about earlier. The other thing is we only want to pick up revenue and expense. So the last word in these captions should be revenue or expense if we put it in this income statement. The header again, company name, what is it, and for the period of time. And now notice we did have $1,000 as net income. After we recorded the income tax expense, our net income is now $800. This double lining here is fairly common for financial statements. You're going to see that again. The top accounts up here are the balance sheet accounts. The statement of retained earnings is done next, and in it we have a beginning retained earnings of 0 because we're just starting out. We take the $800 net income, transfer it down here. Sonic Gate did not pay dividends, So retained earnings should have an ending value then of $800. Well, why didn't we do the balance sheet earlier? Why are we doing it in this order? Well, we need net income so we can go down and prepare our statement of retained earnings. And we also need our September 30th retained earnings balance so we can do our balance sheet. So now we can do our balance sheet, and we are going to pick up this retained earnings value of $800, which was from our statement of retained earnings. As I said previously, the top part here, these are balance sheet accounts. Notice that this credit, which appears here for accumulated depreciation, does not show up as a liability. It shows up with its other associated account, equipment, and is put in here with the other fixed assets. So equipment is shown net of accumulated depreciation at $9,200. Software is shown at $9,000 net of the $250. This line is a little off here, and so the software net should be $8,750. We said that assets should equal liabilities and equity. It's the case. Assets is $43,200. Total liabilities and stockholders' equity $43,200. Again, you've got the double lining going on there. Current assets and current liabilities are listed first on the balance sheet, and then the others follow. So the order it's generally done in is assets, liabilities, equity. Within assets, the current first. Within liabilities, the current first. The last thing we need to really talk about is zeroing out accounts. This is called closing accounts. And what we do is we close out our income statement accounts plus this dividend account. Now, we didn't have any dividends for our company, and so we will not be doing that. We close all those balances out to retained earnings. And because they are closed out or zeroed out, we often call those temporary accounts. So here is really the process that we go through. It's like a cycle for the whole time period. We would be going through and analyzing transactions, doing journal entries. We did this in our previous PowerPoints, in our previous chapters. We prepare an unadjusted trial balance. Notice these are in blue because it's monthly. So only monthly do we prepare these adjusting journal entries and post those. Then we prepared our adjusted trial balance. We did that just a moment ago. It gave us an additional chance to look at our account balances and see if they looked right. And then we prepared our financial statements. After we get the financial statements done, then we go through and we zero out account balance. Okay? And to make sure we've done it right, we then prepare another trial balance. It is called post-closing or after closing journal entries. This will transfer our net income or our loss and the dividends to the retained earnings, and it also zeroes out all those income statement accounts and our dividend account. So the temporary accounts then are expenses, revenues, and dividends. And this counter is just signifying what we are doing with these accounts is we are accumulating these accounts for a time period, and we are tracking them only for this time period, and they were zeroing them out. Assets, liabilities, and equity accounts, they are not zeroed out. Now sometimes it gets a little confusing for students because students will say, aren't these accounts equity accounts? Yes, they are equity accounts, but they are temporary equity accounts. They're not permanent equity accounts. So you are going to need to debit all your revenue accounts because revenue accounts have natural credit balances. and you're going to credit the expense accounts because it has a debit balance, and that will get rid of those balances, and then the difference goes to retained earnings. The dividend account is normally recorded as a debit, so you're going to credit it and get rid of its balance and take the amount to retained earnings. So here we have the adjusted trial balance. So an adjusted trial balance means after the adjusting journal entries have been done. With this, what we would need to do then is just go down and pick up the revenue accounts, take this number, which is a credit here, showing up in the credit, debit it, this number, which is likewise a credit, debit it, and then all these expenses here, we are picking up these accounts and we are listing them. They are debits here, we are crediting them here. This is going to create a journal entry that is not in balance. And the difference goes to retained earnings. So add up your debits, add up your credits, and the rule in journal entries is that debits have to equal credits. So put it either as a debit to retained earnings or a credit to retained earnings to zero out all the accounts and to transfer this amount to retained earnings. The interesting part about it is this transfer to retained earnings, what is it? Do you remember seeing that number a few moments ago? It's net income. We are taking our net income to retained earnings. Likewise, had we had dividends, we would have taken our dividends account, which has a normal debit balance. We would have removed it with a credit and taken that amount to retained earnings. After we do all of these, all the income statement accounts and the dividend accounts would have zero balance. For example, up here we have sales revenue, which is going to be debited for $12,100. We started out with an adjusted balance of $12,100 credit. We create the debit journal entry up here, which is a closing journal entry of $12,100, and afterwards we have zero balance. Advertising expense, $500 here, which is showing up here. It had an adjusted balance prior to that of $500. It takes it away, makes it zero. Now this is just showing a few of these T accounts or ledger accounts. We could have gone through and we could have shown all these accounts here, from sales revenue all the way down to income tax expense. And after we did this journal entry, it would have zeroed them out just as these two have been zeroed out. Retained earnings is not being zeroed out here. Instead, we are transferring an amount to retained earnings. After we do this, we do a final check to make sure of several things. Are our debits and credits still equal? Yes. Have we removed the balances in dividends, revenues, and expenses? Yes. And so all the income statement items which are at the bottom of the trial balance have zero balances, and the dividend account also has a zero balance. This is the very last step in the accounting process. You're going to say, is that the end? No, it's not the end. What's going to happen is all that we have talked about in this semester up to this point gets repeated. We will be going through that accounting cycle. We will be recording transactions, and then at the end of the month we'll be doing our adjusting entries. We will have an unadjusted trial balance, and we will do an adjusted trial balance after we have done those adjustments and posted those adjustments. We'll be reviewing that to see if we think we've missed anything or we need to do some more journal entries to make corrections. Then we will prepare our financial statements off of that adjusted trial balance, go in and remove or close out all the balances and prepare a post-closing trial balance. So this is a process that gets repeated every time we do our financial statements. For SonicGate, their financial statements are done monthly. So every month they will repeat this process and create financial statements and then go through this closing process.